Welcome to One-on-One with Ivan Kaufman, our quarterly web series where we discuss the major trends that are shaping the commercial real estate and multifamily industries in the United States. I'm Sam Chandan, founder and chief economist of Chandan Economics, and I'm joined by Ivan Kaufman, CEO and chairman of Arbor Commercial Mortgage, one of the nation's largest multifamily and commercial real estate lenders. Later in today's program, we'll be joined by Shawn, Horwitz and Kotick with Alliant Capital. Alliant is one of the nation's national providers of affordable housing financing. That'll be our main discussion for today. But before we begin with that, Ivan, it's been a quarter since we've had a chance to talk together about the market. We're halfway through 2016. Where do you see us today?
Well, first, Sam, thanks for hosting us and joining us again. And I hope this webinar proves to be interesting and timely for what's taking place in today's economy. And we have some fascinating topics which we're going to discuss. With respect to the economy and the environment, as a follow-up to our first webinar, things are moving along much in the direction that we spoke of. We spoke a lot about the CMBS market, which was in a tremendous dislocation. We'll get into that. It is adjusting and replatforming itself. The political climate, as you know, is quite fascinating. I think nobody knows what the end result will be, and everybody has a tremendous amount of uncertainty. Wages, the economy, and the general economic environment, much along the lines that we spoke about, but I'll leave each specific topic up to how you want to address it.
Sure. Well, if we could actually begin with the CMBS market, because I remember last quarter you had a fairly definitive view on some of the challenges that we were facing in CMBS. As you described, the market was facing a serious dislocation at that point in time. Have conditions improved?
I think what we've seen is the CMBS market has reset. It was supposed to be a $100 billion plus market given the volume that was taking place on maturities. I think it's targeted more to be a $50 billion market. So there's about $50 billion worth of financing that has to go elsewhere. What's happened on the reset of the CMBS market is financing levels, debt service levels, equitization have all had to reset, as I said, and you're seeing a lot more equitization in these transactions. So the market has changed. Equity investors are looking at it differently, and I think it will affect prices of real estate.
Right. One of the things that we had also talked about last time was risk retention and some changes in the regulatory environment. We're now one quarter closer to the implementation of risk retention. Any change in the market sense of how that'll impact CMBS?
I think that the real issue is, will the Dodd-Frank risk retention rules stay in place as proposed? If they do stay in place, you'll see the resetting that has taken place over the last 90 days stay in effect, and you'll see the levels that are being done in the CMBS market be somewhat similar to what they are today. If those risk retention rules are reset to more favorable terms, then you'll see the CMBS market reset again in a different way. But I think that things should stay in place. You'll see the CMBS market less aggressive, which I think is a good thing. You'll see equitization of real estate being done in a more legitimate manner, and it'll be a different market, but a good market.
Well, one of the things that we've also seen is that over the course of the last several months, we have new data which shows the economy has continued to grow at a moderate but sustained pace. Labor markets are continuing to improve in health. In spite of that, the Federal Reserve seems reticent about its approach to interest rates in the United States. What are your expectations for the economy in 2016?
I think we see stability. Clearly, the effect of what's happening globally does affect us here in the United States, and we're more stable in every single economy that we can speak of. So I think there is a level of stability. Employment and wage growth, where nobody's excited about it, but it is on solid ground. So much of the same. With respect to rates and where the Fed's going to move them to, everybody always thinks they're going up, and every time they think they're going up, they're flat to declining. We've been in the same range now for the last, 12 to 24 months. The consensus would be, if you ask, will there be a rate hike? Everybody's been saying that for the last 2 to 3 years. There's been no rate hike. So I can't predict. All we can do is react.
Mm-hmm. issue of the global economy that you mentioned, and the United States being the most stable amongst the major economies, you're global in your own work. Have your perceptions of what's happening in other parts of the world changed? Any concerns in particular about the possibility of Brexit being disruptive to conditions in Europe?
Look, there's so much have gone on in Europe and the Middle East, and there's so much instability politically. What's going on in Europe with the illegal immigrants and people moving out of the countries and trying to establish new residencies, and how these countries are dealing with these refugees is really creating a tremendous disruption. People are feeling unsafe. Unemployment is probably at the highest levels. There's just an unknown in each and every one of the countries that we're familiar with.
Yeah. So from a global capital perspective, does that mean that the United States looks as attractive to foreign investors in commercial real estate today as it has over the course of the recovery?
I think the United States has been the safest haven for investment dollars, whether it be China, whether it be Europe, whether it be currency issues that created that. But there's been a slowdown because a lot of these countries are starting to restrict the dollars that are flowing. And now that the currencies are not as favorable, they can't buy as much here. So clearly there is a lot of foreign investment here, but not at the same pace that there was.
Right. Well, in a market like New York or San Francisco, where inflows of foreign capital have played such a significant role in driving outcomes, certainly been very visible. Does that slowdown have any implications for the kind of transaction activity or pricing that we see?
I think we've definitely seen its impact on residential condo sales, where a lot of people were taking their money, whether it be out of Russia, whether it be out of France or South America, which we didn't even speak of the dislocation there in countries like Venezuela. Those countries are falling apart. So people was a mad rush to get their money out and to buy residential units for their families. They can't get their money out anymore. So you have a confluence of events of a lot of product coming to market and a slowing of foreign dollars coming to market. So we're going to see areas like Miami, New York, San Francisco, which were very, very strong. Between the excess supply and the lack of foreign dollars, you're going to see a significant softness.
Now, when you're referring to excess supply here, that's specifically in the condo markets of Miami and New York. What do you see happening with multifamily?
So multifamily has been interesting because we've seen, as we talked about on the last webinar, tremendous rent growth. I think we had there's a 4.5% rent growth followed by successive years of rent growth. My prediction is that you're going to see a slowdown of rent growth. Clearly rent growth has been outpaced wage growth, and I think people just can't afford it. The affordability index for rent and the amount of income that people need to afford rents are definitely impacted. So when we're underwriting loans, we're not underwriting the kind of rent growth that's taken place over the last years. We're kind of flat in our outlook.
Is that the consensus in the market? Do you see other lenders, other market participants that are being as judicious in their underwriting of prospective rent growth?
There's definitely a shift, without a question. If you read the newspapers, the way the regulators are talking to the banks about multifamily underwriting, they put a lot of pressure on them. The federal agencies are cautious. We as lenders who have been through multiple cycles understand that this rent growth is not sustainable year over year over year. So while we have definitely taken a step back, we feel most lenders have as well.
Right. Now, you mentioned sort of issues around affordability and a several-year period where rents have been growing at a faster pace than incomes. How is it that American families, renters, are actually making ends meet when their rents are growing so much faster?
Well, it's quite difficult. One of the phenomena that's taken place in New York, and we're actually a participant on the developer side, is people are doing micro apartments. So typically a 2-bedroom could become a 3-bedroom, or 2 people are renting apartments and 4 people are living in those apartments, or families are just subsidizing their children. It's very, very difficult with the rising rents for people to afford it based on the incomes that they have.
Now, given the examples that you mentioned, are we talking about purpose-built micro apartments, or are we talking about apartments where the density is rising and so it might feel like a micro apartment?
I think the density is rising and people are building smaller apartments. I mean, you would be surprised to see how people take a studio and turn it into a 1 or 2 bedroom. And in these urban areas, people like 24/7 living. They don't need to be in the apartment the same way they used to. And they actually like living with other people. So a 2-bedroom, which became a 4-bedroom, and the apartments are half the size, and the living area is half the size, it's okay because the cities have so much to offer.
Now, is that as much of a phenomenon in relatively smaller cities, in markets unlike New York or San Francisco or Boston, where space is at such a premium?
I think you're definitely seeing it in major gateway cities where the affordability index has gone down so dramatically, and you're seeing a great level of density in an individual unit to maximize the rent and make it affordable for the individual.
Yeah. Well, affordability is our focus theme for this quarter's webinar. In the policy environment, we're in an election year. It's certainly a challenging election year. Issues around affordability, do you think they're going to feature prominently in the election cycle?
I think there definitely has been a tremendous push in affordability with Fannie Mae and Freddie Mac and FHA. So there's been that undercurrent. We have housing agencies that have a purpose, so it's existed. I think everybody understands that affordability is the most significant issue right now. And it's just an interesting time, and I'm sure our panel will speak about it later. In times like this where there is too many high-end apartments, there are a lot of units coming to market, I think you'll see developers actually focus on affordability and work with tax credits and perhaps bring on more affordable units at this time. And clearly, politically, it is always in favor to produce affordable apartments. So maybe the confluence of events will create a greater effort on the affordability side.
Welcome back to One-on-One with Ivan Kaufman. I'm Sam Chandan, founder and chief economist of Chandan Economics, and I'm joined, as always, by Ivan Kaufman, chairman and CEO of Arbor Commercial Mortgage, one of the largest multifamily and commercial mortgage lenders in the United States. Well, questions about affordability and affordable housing are front and center in the discussion of the multifamily industry at present, and in part that reflects that we've had several years where rents in the United States have been growing faster than incomes. To discuss the issues that surround affordability and how it is that we finance affordable housing and tax credits in the United States, I'm joined by Shawn Horwitz and Scott Kotic of Alliant Capital. Gentlemen, thanks for coming on today.
Good morning, and thank you for having us.
Morning, Sam.
Both have extensive experience in this area. Can you begin by telling us a little bit about that?
Happy to. Both Scott and I have been involved in the affordable housing industry since the late 80s. And that is approximately when the low-income housing tax credit was enacted into law. Since being involved in the affordable housing industry, collectively we have invested in, underwritten, and been associated with 1,000+ transactions. The company which we collectively run has a portfolio in excess of $12 billion worth of real estate, and we've raised approximately $7.5 billion of tax credit equity.
So you've obviously been very, very engaged in this market. When I think about affordability from an academic perspective, I'm thinking about small a affordability. How are people able to make their rent payments every month? But there is an industry here related to low-income housing tax credits that you mentioned, and what we would think of as technically affordable housing. Can you scope out the industry for us?
Yes. Affordable housing was really enacted into law in 1986 as a means to finance housing for people who could not afford conventional housing. And the premise behind the financing was to incentivize corporate American individuals to invest in housing. And it's done through the tax code, Section 42 of the tax code. So assuming you make certain investments in accordance with the tax code, you get certain tax credits in return for it, which provide a return or a yield to anyone willing to invest in affordable housing. So it's really a financing vehicle through the tax code.
For a traditional multifamily investor, what are the opportunities to engage in the low-income housing tax credit or affordable housing space?
As Shawn mentioned earlier, most of the investors are institutional banks, insurance companies that buy these credits. For what I would call the multifamily investor / developer owner, some of the opportunities if they have an older portfolio, as an example, and say the rents that are in that portfolio are at affordable rents, it gives them the opportunity to turn that into a tax credit transaction. Without getting too technical, to get acquisition credits, you have to own the building for over 10 years, or it has to be subject to some form of federal subsidy. So say if you have that in a portfolio, utilizing tax credits will allow that investor to get out of that, to sell it to somebody, or put tax credits on it. That's one example of how you can use it.
Now, is this a market that has become more active over the last couple of years?
Yes. A number of multifamily owners over the years have aged, such as myself, and they're trying to figure out how to get rid of their portfolios. And some of these are in B and C neighborhoods. The rents have never really kept up with market for any number of reasons. This is an opportunity to do that, and you've seen more and more of that. The other is the credit program is extremely mature. You hold these properties for 15 years to keep the credits. Some owners don't want to keep them anymore. They sell them, they can recycle them, and you're seeing a fairly large business of that right now.
So if an investor had a concern about the liquidity of these assets, I think what you're describing is that making a commitment where the commitment to the low-income housing tax credit may run 10 or 15 years doesn't mean you're making a commitment to hold that asset yourself for 10 or 15 years. You're still able to transact this building?
Yes, so long as whoever buys it continues to keep it as an affordable property.
Right.
Yes.
How rich and deep is that market for low-income housing tax credit properties?
Approximately $10 billion worth of tax credit transactions get done each year. Approximately 100,000 apartment units get built each year, and that's all new stuff. The program has been going since 1986, and generally speaking, after 10 or 15 years, these properties start changing hands. So the number of eligible low-income housing tax credit properties that are either available for sale or to be bought by people interested in buying restricted apartment complexes is huge.
Right. So we're not talking about a market that's unusually niche. We're talking about a market that has sufficient scale, where there's a critical mass of potential buyers and sellers and sources of financing that it would not significantly impinge on investors' liquidity and ability to trade.
That's correct. Yes, it's become very much more mainstream today than it ever has been.
When we look at the new multifamily supply in the United States from the last couple of years, it's tended to have focused on large Class A, high-rise buildings in urban areas, a lot of amenities. When we look at the affordable space, is there a typical set of characteristics? Is there a look and feel for an affordable housing property?
Not really, Sam. All over the country, we do these properties. In an urban, because it's so dense, it typically is a mid-rise to high-rise. In some places now you're seeing, especially in New York and San Francisco, you're seeing market rate along with an affordable component. A lot of the cities are now instituting affordable components to be able for a developer to build his market project. But we've done a number of garden style properties. We've done a lot of rural, which are financed with rural housing funds. We've done historic conversions of old breweries into affordable space. So this business is not a typical cookie cutter business in terms of development. But so we see all different types of transactions.
So it sounds like in terms of size and scale, we're covering a wide range of multifamily properties. Ivan, how relevant is this for the borrowers and investors that Arbor's working with?
I think on the development side in some of the urban areas like Brooklyn, you're seeing a lot of 80-20 projects where this comes into play. We happen to do a lot of financing for people who are acquiring LIHTC deals that maybe there's 5 years left, and they're stepping in the middle and waiting for the opportunity when it comes off of that financing, whether they want to renew it, or there's some substantial rehab projects where tax credits become a component of it. I think more and more, as we get more comfortable with how the tax credit works on substantial rehab, it could become a more significant part of our business, especially with affordability being so prominent with the federal agencies and us putting such an effort into that side of the business.
Right. But you mentioned an affordable component in a number of development projects. As issues around affordability generally have become more significant or more important, are you seeing in a larger number of cities that that demand or that requirement of an affordable component to a development project, has that become more prevalent?
Yes, especially in the bigger cities. Most or a good chunk of what's happening in Manhattan are those 80/20s. Same as in San Francisco. Now LA's starting to impose the same thing. And I think you'll see that more and more in the bigger cities where the affordability crisis is so large.
Okay. There are a number of different ways in which we meet the needs of affordable financing investors and developers in the United States, whether it's through HUD or Fannie Mae, Freddie Mac, through LIHTC programs. Can you tell us a little bit about how these programs are differentiated from one another?
Sure. The LIHTC is the common denominator, and that provides the equity to all of these transactions. Now, depending on whether it's a 4% or 9% credit, there's a certain level of debt attributed to each one. A 4% credit is a tax-exempt bond. Typically, tax-exempt bonds, depending on where the property is located, is either secured through a letter of credit from a local bank, could be credit enhanced through HUD, or Fannie or Freddie. 9% transactions usually have a much smaller loan component to it because there's more equity, and as a result those are more of the Fannie and Freddie perm loans that come in after a construction lender or local bank will provide the construction financing. HUD provides the construction and perm financing all in one. It gives you a little bit longer amortization, a little bit lower interest rate, but it takes a little bit longer to get that loan underwritten and closed.
Now, you mentioned in one of these cases a letter of credit from a bank. Have any of the constraints on the banking sector, any of the hesitancy that we might have seen in the post-crisis period for banks to take on new exposure to commercial real estate, has that played any role in limiting access to these programs?
No, actually, if anything, what's happened over the past several years is banks have been required by the government to invest more and more into communities, and it's called the Community Reinvestment Act. So where a project is located in a particular bank's CRA area, you're finding them more and more aggressive in providing their financing, both on the equity as well as the debt side.
You're currently working on a project right here in New York City, MLK Plaza in the Bronx. Can you tell us a little bit about it?
Sure, it's 165 units in the Bronx, new construction. It's got 33 units of market rate in those 165. The financing is coming mostly from the City of New York and through their different agencies. There's HPD and HDC. There's a small component of bank debt and about $22 million of equity from the tax credits. It's being developed by a local developer here in New York who's done 10, 12 projects in and around the boroughs.
So if you have a local developer who has worked on projects before, is there a particular set of expertise that you need to have over and above what you might have as a multifamily developer?
Yes, the low-income housing tax credit has a lot of technical rules. So you need to know a little bit about tax. You need to know how to put together an application, how to work with the different agencies and the different funding sources. Now, a lot of that can be done through your attorneys, through your consultants, through your syndicators, through your lenders that you have relationships with. But to put the whole deal together, you should have some affordable experience. But you have to start somewhere, and everybody has.
Sure. Now, when you're talking about the MLK project in particular, developers in New York City may focus in their more traditional market rate multifamily development projects on high amenity properties. Does MLK look like that? Is it apartment units that are comparable in size and unit mix to what we'd see in any new development project in the city?
Well, it's not going to look like a related project in the Hudson Yards, although some of those might have affordable pieces in it. But no, they're highly amenitized. You get points from the agencies to get your credits, and the more features you put into your properties, the more points you're going to get. So you get your opportunity to get your credits that way. So it's highly amenitized. There's usually computer labs. It's green space, some public spaces for common areas that are nice, community kitchens, things like that.
In the case of the MLK property specifically, where the majority of the units are taking advantage of the tax credit program and there is a smaller share that are market rate, are there any unique challenges that a developer or operator will face in leasing up the market rate units?
Yes, it makes it significantly more complicated when you have both low-income housing tax credit units and market rate units in the same building. It is a far simpler process to keep it all affordable. Unfortunately, we're seeing less and less of that in the marketplace today, and you see more mixed-use apartment complexes, which does complicate the leasing process and maintaining the affordability and being compliant with the tax credit rules.
What's the advantage to the developer in including some of those market rate units? Presumably there then is enough upside in terms of the income that they might generate that it's worth taking on that complication.
That's exactly it. It's the upside in being able to rent some units or a percentage of the units in the building at rental rates which are greater than the affordable rates.
Right, and we've described how some of those programs are things that we see typically in New York City, in San Francisco, perhaps LA. In secondary markets in the United States, are we where prices for renting may not be as high? Are we still seeing that type of inclusion?
No, we have not seen that yet. We expect that to come down the road. Generally, the smaller the market, the more likely that the only apartment construction going on in that particular marketplace is an affordable housing apartment complex. We have invested in buildings in small communities, and by small community I mean a town of 50,000 people or less, where the only apartment construction underway is some form of affordable housing complex.
Are the programs that we need to have in place to start winning that battle instead of losing it, are they there?
The program is in place, and the low-income housing tax credit program has been the most successful affordable housing program ever in the history of the country. What can be done is the program could be expanded, and I think more dollars allocated towards affordable housing would facilitate more units being constructed.
And there is legislation currently pending that's been introduced in the Senate to expand the tax credit by 50%.
And that would be something that would happen presumably at the federal level?
Yes.
What's your prognosis for that? Is there a chance of getting it done given where we are in the election year?
Well, it would have to happen after the election year, and because it's a tax incentive, it's going to have to be rolled into where we are with change in tax law if that ever happens.
But it's
going to be a while, but it's always had a lot of support.
One of the prevailing concerns in the market rate multifamily space today is that we have a large number of properties under construction. We have a large number of new units that will come online over the course of the next couple of years. Ivan, we have just a couple of minutes left in this quarter's webinar. What's your outlook for the affordable housing segment of the market over the next couple of years?
I think the timeliness of this segment speaks to our outlook. We think that there is a unique opportunity with where the economy is, with the demand for affordable housing, with the weakness on the high side, with the pressure on rents, and with the urgency for Fannie and Freddie and FHA. It's all come together quite nicely, and I think if we can educate our borrowers to understand the potential that the tax credits have for their opportunities, we can really increase that side of the business.
Gentlemen?
We have been in this business for 20 plus years. And every year we've been in the business, we've seen the need for affordable housing increase, and the occupancies of the affordable housing units that have been built increase. So our view is, we can never build enough affordable housing, and the more we have and the more people in our space building apartment complexes in this space, the better.
Well, gentlemen, thank you both for joining us today on One-on-One with Ivan Kaufman. Ivan, looking forward to next quarter and hearing about your outlook for 2017.
Thank you, Sam.
For many investors in the traditional market rate multifamily space, some aspects of the LIHTC programs will be unfamiliar. Can you tell us a little bit about the 9% versus 4% program?
Sure. Why don't I start with the 9% program? The 9% program is a competitive process. And what happens is each state, even though it's a federal credit, the states are empowered to actually give out the credits to the applicant. It's typically a 3-to-1 ratio of 3 applicants to 1 person who gets an award. So what happens is the state prepares what's called the QAP, Qualified Allocation Plan, and they talk about where they want their housing. It may be downstate, it may be north, it just depends. Like use California, they may want more seniors in the LA area, or they may want more families in San Francisco. And you get points based on the certain criteria that are in the Qualified Allocation Plan. So you fill out a tax credit application to get a 9% credit. Now the 9% credit, not to get too technical, is 9% of your what's called eligible basis, which is pretty much all of your costs, less land and a few soft costs. So a $10 million deal, 9% credits, it'd be $900,000 a year times 10, $9 million of credit. And that's competitive. So you have a number of costs that go into filling out your application, tying up the land, making sure you're environmental, market. So you may not get a return on that money at all if you don't get the credits.
And I think what you're describing is about a 1 in 3 success rate.
That's correct.
So it's a very competitive program. How costly is it to actually go through the process?
It varies by state, but it could be several $100,000 for one application, down to $25,000. Because certain states want more information in their application. They want to make sure, because it is so competitive, if they're going to award the project, they want to make sure it's going to happen. So they would require a lot more paperwork. They want, like I said, environmental, market study. Could be a physical needs assessment if it's an acquisition rehab. So you're going to spend a fair amount of money on it. Now you take that with the 4% credit. The 4% credit is it's usually a bond deal. It's based on volume cap that the state has, but it's not competitive. If you have something that meets the criteria, you're going to get those credits. But it's only, and it's not really true 4%, it's based on the applicable federal rate. So it's around 3.2, 3.3% of those same costs that I described earlier. But you can see if you apply the math, you're going to get a lot less credit. Now the reason they do that is because of the favorable financing of tax-exempt bonds. You're going to have more leverage with less credits and less equity. But it is not competitive, and you're pretty much assured that you're going to get the deal